also runs a hedge fund called Karman Capital. Mark is a equity volatility trader. Mark, how are you doing? Give us a quick background about yourself.
Yeah, Greg, thanks for having me. I'm really glad to be here. I was a floor trader for a little under a decade in New York and Chicago on the American Stock Exchange and the Chicago Board Options Exchange. Left, kind of, saw the retail explosion in options starting to happen and realized that there were a lot of people that were basically lambs to the slaughter. Figured it was a good opportunity for me to help people, so started this business of working with traders to teach them how to think and act and not lose their shirt like a professional. And then a couple of years later, I want to get back in trading, so we launched Karman Capital. We are a S&P and VIX trading firm, so we primarily trade SPX and VIX, but we'll delve in other things when we see some real opportunity. When there is money to be made in options, we want to be a part of it. So that is what we do throughout the day.
Cool, that sounds great. So when you were on a trading floor, you were trading what? Just equity index options or single stock?
Primarily equity options. Probably traded 300 or 400 different stocks. I also did some time trading indexes. We would trade the Dow, the S&P against each other. So was doing some index backs when DJX and diamonds were kind of hot. We were in that, but DJX kind of died off pretty fast, and SPX kind of just took over everything. So, yeah, decent amount of index background, but primarily when I was on the floor, I was trading equity options.
Interesting. So now you spoke about trading DGX, Dow Jones versus S&P 500. Are you talking about relative vol, or are we talking about sort of directional spreads?
Relative vol. We were trading vol back and forth between the two. When we could get one underpriced, we could hedge off the vol in the SPX pretty cheaply, and the other way around. When S&P vol got sold to us, we could take it off in the Dow relatively easily as well. So we would trade the relative vol of the two against each other.
So for people who are sort of new to options or maybe new to crypto options, when you say relative vol, this is basically you're trading a vol position that's delta hedged on one index, and you're trading a vol position that's delta hedged on the other index. Is that right?
Yeah, so we're delta neutral on both indexes, and we're trading the Vega. So think of Vega as delta for implied volatility, right? So we all know delta is, you buy a stock, you buy 100 shares of a stock, it goes up $1, you have 100 deltas, you made $100. Vega is the same thing, but it's for implied volatility. So if I buy implied volatility in the Dow Jones Industrial Average for, let's say, a 0.2 cheap, and I buy 1,000 Vega, and then I'm able to hedge that off at fair value in the S&P, then theoretically I made $1,000 on that trade. Obviously, you don't fully realize it till the two come off, but it's a quick way to lock in edge on a trade when you're making markets in one and able to trade in and out of the other.
That's really interesting. So kind of sticking to this idea, when you're trading relative vol, what is your entry and exit criteria? Like, what makes you think, or how do you know that the relative vol is too cheap or too expensive? Is this kind of like a moving average thing, or what's kind of the thought process behind it?
The thought process behind relative vol, well, when we were on the floor, we were making markets in kind of both places. So we'd have opportunities to just basically lock in the edge. Now, when you're doing it as a retail trader, things get a little different. Now, volatility can get oversold and overbought in different names or in different cryptos. And the way that you can, so for instance, Bitcoin may go parabolic or ETH may go parabolic. And we know there's relatively high correlation between the two of them. You could theoretically take off some of your volatility exposure when you're short. Let's say you sold some volatility in ETH, you could then theoretically take off some of that risk in Bitcoin options or some similar option that you see. It takes some work. It's intricate, but and it takes being a little bit more nimble because those pockets when vol really does go parabolic in those names, you know as well as I do, they don't last more than a few hours or maybe a day if you're lucky. But at the same time, especially in crypto, the way those can just completely take off. It's more important, I think, if you're going to be an option seller or an option trader in those names, and you don't have a big, huge underlying that you're selling against, that you need to actually step in and trade these options off of each other, because one goes, the other one goes, and otherwise you can get yourself in some trouble. Being short options can get you into a ton of trouble in these names because they can explode higher, and then when they explode higher, vol actually goes up, and on the other end, you don't want to get caught carrying, holding the bag. So how do you stop holding the bag when you buy some call options in ETH when it's rallying? Well, you maybe can sell call options in Bitcoin, or sell puts in Bitcoin, or do something along those lines where you can reduce your overall crypto market volatility exposure.
Cool, fantastic. So before kind of moving forward and talking about what you trade in your current present day, I know you're a big VIX option trader. Let's step back a little bit. And how did you first get into trading? Did you study economics in school, math in school, computer science? What was your sort of introduction to trading?
I was a finance major, and again, this was in the year 2000, and so options and derivatives were just starting to really get put into the forefront. One of my college professors that I had a real good relationship pulled me aside and said, "Hey, we're starting a derivatives class. You're gonna love it. It's gonna be really hard, but you're gonna really like it. You should take it." And so I did, and he was right. And so then when they were doing the interview process on campus, Group 1 Trading came in and were interviewing for option market maker trainees. I interviewed, they hired me, and I moved to New York. I spent a year, and this is one of the things I think a lot of traders need to understand, is what you're really up against. I started out with 20 people in my class. 7 of us got put on a badge. Within a year, only 4 of us were still traders. Best of my knowledge, about 2 of us still are directly in the options market right now. And so that is who you are trading against when you think that you know more than the overall market. That is how you get in trouble. A lot of people will spend more time reading the directions on a box of Kraft macaroni and cheese than they will in learning how options work. And it should be the exact opposite. Options, like I said, I spent a year training going through this program. These guys that I was working for paid me a pretty nice salary out of college to essentially be a sunk cost, knowing they were going to fire 70% of the people they were hiring, because they saw the upside in, if I was successful, how much money I could make them. But that is the weed out process, and what you get to get into this business.
Yeah, that's super interesting. So essentially, Group 1's perspective, hiring employees are like getting long options and hoping one works
Yeah.
out. And the
They
rest expire
bought
worthless.
20 call options and sold about 15 of them at zero. But the few that worked did really well, and so that is why that trade works for them.
So speaking of kind of learning about options, so you yourself, you have Option Pit, and you've also written a couple books. Is there any other books that you recommend in this space?
So my second book, we rewrote it. It's coming out as a second edition. It's going to be hardcover, full color. That is going to be in September. If you are a serious option trader who already kind of knows the basics of the business, then you're going to want that book. It is going to really give you the insights into how I think as a trader and how I make money. Now, the Bible of our business, and I'll pull it down right now, 1 second. The Bible of our business is this book. It's called Option Volatility and Pricing by Sheldon Nadenberg. And if your goal is to do anything more than sell covered calls against your crypto, or then this book is mandatory reading. All right, and so read it. I've read it probably 13 times, maybe more. You can actually highlight things that are really important. And, I've read it front to cover. probably, like I said, 13 times, and I still go back and reread stuff. It's a great book. My books, like I said, they're coming out with the second edition of this one. This is called Trading Options for Edge. Don't buy it now. Buy it in September when it comes out. Pre-order it. And then if you want to understand managing a business, and really, when you're an option trader, when you're running a fund, you're running a business. That is what we wrote this book. It's called The Option Trader's Hedge Fund, and it is the business framework for building an option trading business. So if your goal is to be a professional option trader, understand the processes, this is the book for you. Other books that are really good and really will take you to another level. The last one would be Dynamic Hedging. I don't have a copy of that on my person right now. I think I loaned it out to somebody. Dynamic Hedging by Nassim Taleb. It is hands down the best book. Everyone knows Fooled by Randomness and The Black Swan. His best book is called Dynamic Hedging. Really digs into how you can manage weighted, and the big thing that he digs into that I think is really important is called weighted Vega. The fact that Vega that you own that is near dated has a different feel to it than longer dated vol, and they move differently. So the concept of weighted Vega is actually very important.
Awesome. Yeah, those are great recommendations. And I think we're 3 for 3 now on Sheldon Nattenberg's book, and two out of 3 on the Dynamic Hedging book. So that's
there you go.
Awesome. And I've read The Option Trader's Hedge Fund. Great book. Really like it. Can't recommend it
I'm going to
enough.
send you a copy of my new one when it comes out. So you don't need to buy it.
Awesome.
But you can buy it for 15 of your friends as a present if you want. But I'll send you a copy for free.
Love it. Thanks, Mark. So kind of going back to your trading career, and again, we'll kind of close up with sort of VIX trading, because that's a super interesting asset class. But going kind of before that, in your trading career, is there big lessons that you've learned over time? Is there any kind of crazy big loss win stories that you've experienced or witnessed others? Any kind of wisdom that you could share from a experienced career in the markets?
Yeah, absolutely. So let me share a couple of things. All right. You ever seen Glenn Ross?
Nope.
All right. Well, Alec Baldwin steps in. They're selling real estate, and he leads off. The very first things he says is ABC, and that stands for always be closing. So always close. Always be looking to close positions. The most money I ever made in a single day was because I saw some cheap option positions that I was short, and I covered them, and then the stock dropped 80% overnight. And if I had not covered those, I would have lost several $100,000. Instead, I made a couple $100,000 on the trade. My worst loss, same thing. I didn't close out a cheap trade. Could have got out for a quarter. It went to 50. So that really hurt. And so 1, don't trade too big. 2, close your trades. A lot of people don't want to pay commission on closing trades. Close cheap options. They're not worth it. There's amount of an option, all right? When you look at the decay out of an option, there's the easy money and the hard money. Once the easy money has been made, cover. And that is the way I always trade. That's the way I've always traded, and the way I approach the business of what we do here.
Yeah, actually, to that point, that's something that I read out of the Option Trader's Hedge Fund that always stuck with me, and I read it, I think, 10 years ago. Basically, if you're selling, let's say, a credit spread and you get paid 50 cents, and the next day that credit spread is worth 25 cents, but there's still 3 months left to it, close it out, because you made all the return, the quick money. It's done. So that's super interesting. Love that. Okay, VIX options trading. So for those of you who are not familiar, can you explain what is VIX, and what does VIX options trading look like? Obviously, there's futures, there's VIX futures, all that stuff.
Yeah, so VIX option trading is definitely a different animal from equity or even index vol. And the reason is, let's start with the VIX itself. The VIX is an index. So the S&P 500 is the 500 biggest stocks, weighted by market cap. The VIX index is an index on the overall implied volatility of the S&P 500 with 30 days to expire. So it weights those options based on the total amount of Vega left in the option, and then basically produces an overall volatility for the S&P 500 out 30 days. Then from there, you have the VIX futures. The VIX futures are European settle. That means there's no early exercise, and that's important because one of the things about volatility is the mean reverting process, right? And I'm sure if you've traded around in crypto, you've seen this as well. When volatility is really high, it eventually comes down. When volatility is really low, it eventually goes up. So because VIX futures are European settled, there's no early exercise. When volatility is high, we tend to actually see the VIX trade at a premium to the VIX futures. That's called backwardation. And then when volatility is low, you'll actually see VIX futures in what's called contango. And that's when the VIX is actually trading at a discount to the futures because the futures are anticipating movement in the VIX, not just where it is right now. And if you've traded VIX options, the underlying for those options is actually the VIX future more than it is the VIX index itself. So when I'm trading VIX options, I don't even look at the VIX, really the index itself. I'm really only paying attention to the VIX futures.
Yeah, so that makes a lot of sense. The cash index is not what the options are pricing. The VIX futures are what the options are pricing. Very, very
Absolutely.
interesting. So is there any kind of strategies that, how long have you been trading VIX options for? And is there kind of any strategies that you feel comfortable sharing that you've learned over the years?
Sure. Yeah, I've traded for a long time. The most popular strategy is it's called the convergence trade. And typically what people will do, traders will do, is they will look at where the VIX is and then look at the actual future. And at expiration, all right, for that expiration, going into that Tuesday before Wednesday settle, the two of those basically are going to merge two on top of each other. So when the VIX futures are at a big premium, there is the potential to buy puts that are underwater relative to the cash index and out of the money or at the money relative to the future and play on the futures actually sliding toward the index. That concept actually also plays into some of the ETPs like UVXY and VXX. On the other end, when hedging, the most popular approach is a ratio spread. Traders will sell a near the money call and buy several out of the money calls because when the VIX moves, it actually probably trades more like crypto than just about anything else out there. When the VIX goes up, it just keeps going and going because people are scared. So it's not people chasing crypto higher, it's people chasing protection higher. So the VIX has a tendency to go parabolic. And if you want to see what I'm saying, go take a look at what happened in March and April of 2020, and you'll get a really good glimpse of how quickly that thing can move and why these ratio spreads will work. The other thing I'll do, especially when vol is low, I'll trade strangles in the VIX a lot. When playing for volatility to converge lower, and then if we do get a pop, because sometimes the pops are also short-lived, I'll take my money and then end up owning those puts for free. So there's a lot of different ways to skin that cat, but I really find VIX options to be a great way to produce dollars over the long haul.
So to that note, Derivs launched a Dval index, which is the VIX of Bitcoin options, and they're going to be launching VIX futures or Dval futures against it. And I think eventually the hope will to be having sort of the
Dval options.
Yeah, Dval options.
And that index is the way that is gonna be structured, assuming they're European settle, which they will be, it is gonna trade almost exactly the same way VIX trades. Now, here's where there's gonna be opportunity and why I might jump in. They're gonna be, when they initially launched this, and this happened with VIX, a lot of stupid people thought that the underlying was Dval or VIX. So they would buy calls and say, hey, look, the VIX went up. Why am I not making money? Or they buy puts and say, oh, the VIX went down. Why am I not making money? And not realizing that the underlying was the future. And so all these options trade at ridiculous prices. And the guys, the first year in the VIX option pit, those guys made money hand over fist simply from people that didn't understand how the actual, the mechanics of VIX options. And I expect Dval to be very similar. So those first few months, when it's kind of the Wild West, that is going to be, you and I may need to get together and build a market making firm just to take the other side of all these trades, because it is going to be absolutely bananas how easy it is to make money if you're making markets early on in Dval, because there will be a lot of people that are not sophisticated, that don't understand how these crypto options in Dval actually work, and they're going to get their lunch handed to them.
Yeah, very interesting. Okay, a couple more questions before we sort of jump into some more fun personal stuff, and then
Sure.
we'll close it out. So as far as trading VIX options goes, the VVIX index is something that
Yep.
I know that you look at for a fact. What is how did you incorporate VVIX? Can you explain VVIX real quick?
Yeah.
And how do you incorporate it in trading?
VIX index is the index on S&P options. So what they did was they said, well, what's the normalized volatility of VIX options with 30 days to expire? And that is the VVIX. And that is, I use that more as an indicator. There aren't options on it. And, it really is one of the major pieces I use in kind of the traffic light that I built around VIX to kind of tell me where the market is going and what it could be doing. That is a proprietary thing we use within the fund. But what I'll basically tell you is that when you see VVIX declining in a declining market, that is not a good time to be long vol. And that is going to get you into a lot of trouble. And likewise, when we see VVIX start to tick up, even as volatility is dropping, that is usually a sign to start looking at getting long vol. It also is an interesting tracker for the S&P 500. It is shockingly inexpensive right now as we're recording this. It is at about a 26-month low right now, trading right around 90. So VIX options are about as cheap as they've been in the last 2.5 years.
Yeah, that's fascinating. Very interesting. Cool. So everyone who's been a trader knows that trading is a full-time 24/7 job, essentially. How do you, balance your life? And, I know you have a family. How do you find time to do everything? And what do you do for fun?
All right. Well, the one thing is that when the market closes, this is the biggest thing retail traders need to learn is you need to be a robot. When I win, when I lose, you should not be able to tell. All right. So, for instance, I am doing very well today. I am doing very well in the S&P. So what? All right. Now, I could be happy when you make money. So when you text me and say, "Hey, dude, I just crushed it in some ETH calls or something," I'm overjoyed. But for my own personal trading, I'm done. And then at 3:15 when Central Time, when S&P options stop trading, I kind of shut off. I go play with my I go hang out with my family, go have dinner, do the things that normal families do. And then after the kids go to bed, I come back, look at my screen, and kind of prepare myself for the next day. So my trading day is really kind of 7:30 to 3:15, and then from about 9 o'clock on, I'll dig in and do some research. But you have to give yourself some free time to relax and hang out and do stuff. Most of I've got a 12-year-old and a 5-year-old, so I don't have my own life. It's mostly just their life right now. But I like baseball, basketball, all that stuff. Tomorrow I'm flying to Cooperstown with my 12-year-old, and he's going to be playing in a baseball tournament at the Cooperstown fields. Then we're going to go to the Hall of Fame. So watching a bunch of Cubs games, that's my life.
Love it. Love it. Well, thank you so much, Mark. And if anyone wants to learn more about you, your fund, Option Pit, how do you get in touch with you?
Yeah, so go to optionpit.com. I write up a VIX blog every day on what's going on with VIX, what I'm seeing, how I'm positioning myself. We write a more macro blog that also puts out some crypto stuff called the Pit Report that's worth reading. So if it's definitely worth your time to check that out. So just go to optionpit.com, check out our different writers, and I think you're gonna enjoy the content that we give you.
Awesome. Well, thank you, Mark, and thank you everyone for tuning in. And remember, find edge, capture alpha, and slang size.
If you know what you're doing.
No, just do it anyways.